Mortgage holders in trouble. Let's have a look. Hello everyone, Florian.heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee. We're going to have a look at an article written by Tarek Brooker about, a potential interest rate rise and mortgage holders in trouble. But before we look at that, I want to just draw your attention to this meme from, Dad Patrol on the Facebook group that I found, and I've shared this on the Discord channel here for HeiseSays. If you haven't subscribed to our channel, jump onto it, and you can partake in all of the extra discussions and share links and things which just can't be shared on YouTube. Now, here's an interesting meme. Millennials, come on, collapse regarding the housing sector. And I feel this could be a universal meme. There are going to be some people that see, mortgage holders in trouble. Well, the cash rate is so low. I'm waiting for those people to deserve what they get. Those greedy people that are borrowed right to the edge. If we really had a big housing collapse, it's not going to be the older generations or the people that have a lot of buffers that are going to feel it. If we have a look here at property, you've got people that have, paid ahead on their loans, owners, even investors. You've got people, indebted homeowners and outright owners who've got significant liquidity buffers. If we see a sharp correction to the housing market or a collapse, that's going to ripple through the entire economy. And it's going to be those renters there with smaller liquidity buffers, maybe those saving up to get into a job or to get into a house, or those with less secure income or those earning less, that are going to feel it more than others. We also have to remind ourselves that here in Australia, there's a little difference in... that's JobKeeper. I didn't want to bring that up. There's a little difference in the household income groups here. And a lot of that often relates to age as well. There's a reason why younger people don't have as much wealth. But here we're talking about millennials. And, as a millennial, we're just hitting 40, guys. That's it. The midlife crisis are appearing now. So let's have a look. So before people are all excited at the prospect of a correction, just think who it would hurt if it would happen. And we've got to remember here, even if the RBA are forced to increase their rates, the banks anticipate a rate increase when they're giving people a mortgage. I know everyone likes to pretend they just hand out money willy-nilly, and it feels like it, but they do anticipate a buffer. And a lot of people would have the capacity to handle a little bit more. Sure, there are going to be some that are right at the edge, some that are acting stupid, borrowing way too much. They're either going to have to learn the hard way what you need to do to keep a house. That's a lot of budgeting. Or they're going to have to sell. And the thing is, unless you have a flood of property on the market, which the banks aren't going to be willing or want to avoid at all costs, as we've seen, as the government now in Victoria, they're going to be homeowners in everyone's house. If you go in this scheme, they won't be willing for that. No one wants it to go down, everyone. The states don't. Federal government doesn't. The banks don't. Property owners don't. No one does. So let's have a look. So, in the old Looney Tunes cartoon, Wile E. Coyote would always chase the Roadrunner, attempting to catch him to eat for dinner. Over the course of many episodes of the show, Wile E. Coyote would come up with all sorts of crazy schemes to catch his nemesis, from strapping giant Acme rockets to his back to cleverly concealed traps. Yet despite the enormous amount of effort he put into achieving his task, he never did manage to make the Roadrunner his lunch. I think Family Guy actually did an episode of where he caught the Roadrunner, and he had no purpose left in his life. This brings us to the Reserve Bank. Yeah, okay. Or for the purpose of this story, our Wile E. Coyote. Since last raising interest rates almost 11 years ago. Just dwell on that for a moment. We've had over a decade where rates have just gone down. So in the 28 years since we've last had a recession, they've barely raised rates. The RBA has cut interest rates time and time again in an attempt to achieve its inflation target of 2 to 3% annually. And here we have the chart. I haven't bothered to update mine, that's why it cuts down here. In essence, the idea is that when the RBA cuts interest rates, households have more money to spend on consumption and businesses have more of an incentive to borrow to invest in improving their business. I think we know where this is going to go, don't we? In times now long past, the relationship between lowering rates and business investment worked relatively well, helping to ensure decades of prosperity for the vast majority of Australians. But in the years since the GFC, things have changed. The RBA cutting rates is no longer a sufficient incentive for businesses to borrow to invest in anything like the numbers that did so previously. Maybe these businesses needed to borrow to buy houses. Instead, in recent years, the mantle of lower interest rates driven activity increasingly fell to households. So the wealth effect. Another key part of lower interest rates driven consumption is a result of the so-called wealth effect, whereby homeowners feel wealthier due to rising home prices and feel incentivized to go out and spend more than they otherwise would have. Now, before we continue with the article, one thing I want to highlight here is Australia has a declining manufacturing sector, and the complexity of our economy is going down. Our economic complexity is at a lower level than other countries. And if we bring up here, we'll bring in the Harvard. We'll mix it up a bit. They're saying we're 86th in the world with regards to the complexity of our economy. This is to do with what we export, the manufactured goods that we export. It's not as advanced as other parts of the world. People, will moan in the comments, people are buying Chinese, it's all rubbish. No, some of it's pretty good. Some of it's better than what we could even manufacture here in Australia. We've lost a lot of the skills. Now think about it. Why, as a business person, would you take all the risk and effort to set up a business here when you've got, the not in my backyard crowd driving up the cost of where you can put your factory or your facilities, all the council regulations being a pain in the arse. Then you've got all the labour issues here in Australia where you're pretty much a parent for your staff and your workforce. Then you've got all of the environmental considerations. Then you've got to push for renewable energy, so power is going to get more expensive. Yeah. That's just what I can think at the top of my head. When you have another option, you can offshore a lot of that workforce and hassle, the facilities, manufacturing, you can offshore it all for a fraction of the cost. And then put your money into good old Australian gold, also known as housing, everyone. Can you blame people? I've met many business people I remember having coffee with engineers. They've got 5 people here. Their entire workforce was sent overseas. One of my colleagues from university, a former housemate, she started up a business. She just had a few graduates or students here. She'd, checking the work. Everything else was documented overseas. That was how she could compete in the residential sector because everyone wants it cheap. Everyone wants it cheap. Everyone wants it competitive. So, yeah, that's why I see one argument for private business investment is going down. So, the wealth effect. While this psychological factor is challenging to quantify, what we do know is that rising house prices helped homeowners borrow nearly $93 billion against their homes in the year to June to spend as they chose. Yet despite the billions of dollars of household consumption, the RBA has failed to achieve its inflation target for years. The threat of rising inflation. And we're seeing this all over the world at the moment. Now, there's arguments that it's just transitory. At least that's what's coming from Yellen and the Reserve. We have to see. I mean, a lot of it is to do, there's shipping issues that's slowing it down. Lumber skyrocketed and has now come back down. Coal is shooting up. It's at a peak. Coal is up. Iron ore is up. It's come back down. So this is the thing. When you shut down the global economy, there's going to be some time for it to get back up and running again. According to the latest inflation figures from the ABS, annual inflation is currently sitting at 3.8%, well outside the RBA's target band. One of the contributing factors in these strong inflation figures is the impact of last year's lockdowns distorting the data, yes. But when you start to strip out the impacted components of the consumer price index, it becomes clear that there is a strong inflation impulse in its own right. And remember, housing isn't completely calculated in this. The Australian public see things pretty similarly. According to ANZ's Inflation Expectation Index, households are expecting inflation to run at 4.7%, the highest rate since 2014, and the index has risen rapidly to this level. So, And this Australia is not alone. Inflation is rapidly becoming a major issue across the globe. In the United States, consumer confidence has plummeted as the cost of living rises well above wages. In New Zealand, concerns about inflation have prompted the RBNZ to raise interest rates earlier this week, following well over a dozen central banks globally that have raised during 2021. So, if these strong inflationary pressures continue, as many prominent economists increasingly believe they will, then the RBA may end up with a problem. But they want their inflation. You know, they haven't had it for so long, so just let it run for a decade. Then it'll even out. It'll average out. Oh, boy. Inflation, the hidden tax. So, through the impact of global supply chain issues, rising energy prices, and pandemic-driven demand, its inflation goals may not only get met, but may be significantly exceeded. Yet despite the threat of rising inflation forcing the RBA to raise interest rates, the RBA Governor Philip Lowe remains committed to rates staying low until at least 2024. There you go. This is quite a contrast to other central banks throughout the Anglosphere. In Britain, the Bank of England is expected to become the first major central bank to hike rates, and in the US, speculation is building that the Fed could be forced to raise rates next year. The RBA is widely accepted to resist the push to raise rates, even if supply chain issues and other pandemic-driven factors keep inflation above their target band. This brings us back to the good old Wile E. Coyote. As rates continue to fall, rate cuts lost much of their effectiveness in spurring businesses to invest. Bloody oath they did. To create jobs and expand their capabilities. I'd argue that the lower rates get, the cuts that they get, I would argue that they would have a greater negative impact on the economy just due to falling consumer sentiment and concern. You're thinking, damn, things must be getting desperate if we're at 0.0%. But now we've been anchored at this for so long. Do you reckon they'll go negative, guys? Well, no, we need to get the central bank digital currencies before that can happen. Arguably, partially as a result, inflation-adjusted household disposable income per capita went practically nowhere over the same time period. Yet, like Wile E. Coyote, the RBA keeps doing the same thing over and over in an attempt to achieve its goals. Now, however, the shoe is on the other foot. Instead of cutting rates again in pursuit of its 2 to 3% inflation target, it may be forced to raise rates in an attempt to achieve that same goal. If the RBA is forced down the same path of raising interest rates as the RBNZ and a long list of other central banks, Aussie mortgage holders could be in for an unpleasant surprise. Despite being promised 3 years of no rate hikes by the RBA, rising inflation and moves within global bond markets could force their hand much sooner than that. After no rate increases in almost 11 years, a rate hike or series of rate hikes would come as quite a surprise to borrowers accustomed to rates going only one way, down. In the same way that the RBA's routine of rate cutting boosted housing prices on their way down, the RBA being forced into rate hikes may have the opposite effect on the way up. Where rates head from here in reality is anyone's guess, but the experts have been known to be wrong. But one thing is clear, if a series of rate hikes are forced on the RBA, it could blow up in a lot of people's faces, just like it did with Wile E. Coyote. So, what do you think? Let's have a bit of a talk about what Tarek has written here. So, if we do see a significant rate hike increase, guys, it is going to affect a lot of people. But as I was saying, you've got people that have prepaid their mortgages. You've got people that have locked in their mortgages. How many people have locked in a sub 2% mortgage for the whole period that the RBA has indicated a rate hike will not occur? So I'm locked in till 2024. So what will happen is you may get a whole lot of people that have locked in. So a rate hike won't immediately affect a significant amount of people. But then all of a sudden, you jump from 2% mortgage to a 4% mortgage to maybe even a 4.5% mortgage in 2024 if they're starting to hike rates. But that would give you enough time to prepare and plan. We can see here how many people are in prepayments. We can see here negative equity is trending down. And liquidity buffers exist for people, for outright homeowners. They've got 10 months. Indebted homeowners, 4 months. Renters even have 2 months. Now, here's the liquidity, household liquidity and debt as a share of their disposable income. Now, are we going to see a significant correction? There will be some people that if rates go up, they're on variable mortgages, they're too close to the edge, they may be forced to sell. Will the banks force them to foreclose? I can't see them willing to do that. I can see everything happening to oppose it. And remember, if inflation goes up, what if houses just stagnate, everyone? What if prices don't shift? Remember, they're slow-moving assets. People do everything they can to hold on to them. The investor stock, sure, it's a little different. But then, of course, they can just open up the country as well to deal with it. So we'll have to see. We'll have to see. I think even if the RBA increases rates, I can't see it having a dramatic impact on a lot of people. I think it would have to be sustained rate increases for some time or big, sharp, dramatic movements. What do you reckon? I don't know if we're going to see the 80s. You got to remember, if you get double-digit cash rate, you're also earning double-digit money on your savings as well. So it works both ways. So there you go. Maybe the trick is now borrow a whole lot of money low, fix your rate, then put it in a savings account, then you can pay off more. Yeah, that never gets messy or goes wrong. Anyway, let me know your thoughts and opinions on this one, guys. Are you worried about the potential for an RBA rate increase? Oh, wait, one thing as well. One thing we'll look at here, and I'll bring this up before I'm so wonderfully organized. This is just the RBA rate indicator. We can see here for the 8th of October, there's a 25% no change at the next meeting and a set prediction of a 75% decrease to 0%. So the indicator is telling us that rates aren't going to go up, guys. Anyway, thank you for watching. Like, share, and subscribe to the channel. If you're a fan and enjoy the content that I find and put together here, there are a few ways you can help out. You can join the channel on YouTube or Patreon. Sign up for SelfWealth or Stake. Use our affiliate link at Amazon, eBay, Independent Reserve, or AussieBroadband. Buy our merch at HeiseSays. Use Gold Pass at the Perth Mint or support us via PayPal. Take care, everyone. Have a great day, and I'll see you in the next episode. Bye for now.